All right, it's time for a reality check on American Equities index annuities. They keep releasing this performance chart showing what appears to be, at first glance, maybe the surrender value of an actual, cherry-picked index annuity contract owned by an actual customer. And every year, there may be insurance salesmen out there parading this chart around in order to suggest to unsophisticated investors that traditional investing is too risky and it's going to send you to the poorhouse. And I'm going to show you how any such insurance salesmen are just plain full of crap. By the way, American Equity sent me, and they didn't even send me a letter, they sent me an email telling me that I was never given permission to use their real benefits graph. And unfortunately for American Equity, last time I checked, this is not North Korea or the former Soviet Union. Last time I checked, my feet are firmly planted here in America, where it's my civil liberty to critique and criticize your graph. It's called fair use. I don't need your permission. So without any further ado, I'm going to use their chart again for educational, teaching, research, criticism, news, and commentary purposes. And God forbid, I'm also going to show people what happens when you overlay a line showing the S&P 500 index with dividends instead of what they did, excluding dividends. That's right. With this line here, they have excluded dividends. And I bet you 99% of investors have no clue about this. I'm also going to overlay on top of their chart what happens when we take the lowest risk instead of the highest risk of 100% stocks. Gee, look how consistently a 2872 mix outperformed the annuity. Does this look risky to you? Are you losing sleep? No, of course not. Yet I watched a video from American Equity where the guy's talking about how their index annuity is so great because you're not taking any risk of ever losing money. And this is what the insurance industry does. They put on a show for investors who are ignorant of bonds and how if you want to mitigate stock market risk, you simply invest more and more on the bond side. Then you get consistent results. So now what happens if you suddenly need to get your money back? Unlike index funds, which are traded every day on the NYSE without penalty, index annuities have massive surrender penalties. And one of American Equity's index annuities, which I don't know if it is or isn't still available, called the Bonus Gold Index 1-07, has a 16-year surrender period starting at 20% in the first year. Is this thing on? You have got to be kidding me. Do people actually fall for this stuff? And so this annuity value here in their chart isn't actually cash surrender value. Now, apparently you can take out 10% penalty free, but obviously if you want to take out 100%, you're screwed. So again, this line here is a fictitious value. This is not cash surrender value until we get to year 17. In reality, if you wanted to do a full surrender, this line that I created represents your true cash surrender value. And notice how at all times, this surrender value is well below what you would have earned with a low-risk 2872 mix of index funds. And I would compare index annuities to playing a game of roulette in Vegas over a long period of time where, there's a 96% chance of winning each spin, while the casino has a 104% chance of winning. The law of large numbers is going to win over. Is it theoretically possible that you can come out the winner? Yes. Is it likely? No. Insurance companies have discovered that no matter what crediting method they let you select, whether the S&P 500 index, the Dow, 10-year treasuries, whether monthly point-to-point, whether yearly point-to-point, annual monthly average, with participation rates and caps, which can be adjusted at the discretion of the insurance company, their math experts have discovered that even while the insurance company is investing your money in 70 to 90% in bonds, over time they will come out the winner. Law of large numbers. The longer and longer something plays out, the more and more likely the insurance company will reach their expected results. And so when you look at an annuity with a 10 or 16-year surrender period, in the early years, you might have wild fluctuation, but the insurance company is protected because in the early going, they have enough surrender penalties that they're covered. You see, way out here in year 17, there's no surrender penalty, but by this time, it doesn't matter because their low-risk, consistent portfolio of 70 to 90% in bonds has performed as expected. It has predictably done better than the promises they made to annuitants. And one of the ways that I mentioned that insurance companies stack the deck in their favor is that they can lower caps. And according to a post on Runnymede Capital's website, apparently American Equity has indeed lowered caps. This is what insurance salesmen don't like to tell you. Insurance companies can change the rules of the game in the middle of the game. And therefore, it's a red herring for any annuity pushing advisor to tell you about some annuity that was paying a higher crediting rate of return back in 1998 or 2000. 10-year treasury bond yields were around 5% back then. Now they're in the 2% range. And so insurance companies adjust their caps according to the yield environment. Again, past performance is not indicative of current annuity roll-up rate returns. According to Chris Wang, in today's low interest rate environment, with all index annuities, that's all index annuities, you're going to get between 1 and 3%. So if some insurance salesman starts telling you that you're going to make out like a bandit and I've got this one insurance company that's playing Santa Claus, Mr. Advisor is distorting the truth. So the bottom line, index annuities are sold to unsophisticated investors who are unaware that, number one, investing is simple. You pick 2 index funds. And number 2, investing doesn't have to be wild and volatile. If you're terrified of stock market crashes and low risk fits your investing profile, then put somewhere in the neighborhood of 72% in a total bond market index fund and only 28% in a, for example, S&P 500 index fund. Problem solved. I mean, look at how badly this annuity was beaten, and during the worst of times during the lost decade. Look at the returns this annuitant missed out on. $35,953.